Hello participants, how are you? I'm Kayed Johar and today's day 5 of our financial management practice to pass sessions being conducted by ACCA for revising financial management to sit in the March 2021 exams. So let's start doing our today's work. So our today's work will include a little bit of working capital management, and then we'll be doing the risk management work in today's session, and then we'll be telling goodbye to each other, and we'll keep communicating uh, through the WhatsApp group on your conceptual questions, and whatever queries do you have, you can ask on the group to me. Once we finish with this workshop, I will be also sharing the Excel sheets with you people by either tomorrow evening or on Sunday, right? So, okay, let's start today's work. So our next question is question number 4 on working capital management, which is ZSE company. So students, you are please requested to first read the question so that we can start doing it in around 3 minutes time. Let me first tell you about the requirements. We are going to do requirement A, calculate the following values. A1, the expected value of the period 1 closing balance. Then the expected value of the period 2 closing balance, the probability of a negative cash balance at the end of period 2, and the probability of exceeding the overdraft limit at the end of period 2. These are the 4 requirements which we need to do in this question. And then an analysis to manage the cash flow. So please go through the question. I'm giving you 3 minutes to read it, then I'll start. Okay, students, let's start doing this question. According to the question, first of all, we need to see that what was the opening balance of cash, right? So opening balance of the cash was 500,000 overdraft, a negative balance, an unfavorable balance. Now, starting with the opening balance minus 500, they are asking you to calculate the expected value. They're not telling you to find the closing balance only. They are telling you to find expected value. Why they are telling you to find expected value? Because there are various possibilities of receiving cash in this period. So starting with the opening balance, which is minus 500, and overdraft balance, there are three possibilities. There are three possible cash flows, three possible receipts and payments that can occur in the period 1. The first cash flow is 8,000 receipt. So if they receive 8,000, their net balance will be 7,500 at the end. Then if they receive 4,000 period 1 cash flow, then the balance will be 3,500 by the end of the period 1. And if they pay minus 2,000 further, then their overdraft balance will increase to 2,500. So these are the three possibilities. Now obviously all of the three possibilities cannot be present at the end of the period. There is going to be any one of these, but if these type of cash flows keep occurring again and again, then we can calculate an average cash flow. So what can be the average cash flow? So for average cash flow, the probability is 10% of having an ending balance of 7,500. Then there's a probability of 60% of having an ending balance of 3,500, and a 30% probability of having a balance of 2,500 negative overdraft. So multiplying the ending balance with the probability and then summing up all the possibilities into probabilities will give you the expected or the weighted average cash balance. So the expected value of the ending balance by the end of period 1 is 8,550. Earlier also we did a question on probability and joint probability. So this is the use of probability only in the period 1. But now if you are predicting period 2's cash flows, you have to use the joint probability, because the second month's cash flows, the second period's cash flows are dependent on the ending balance of the first period as well. So obviously the 10% there are chances of the ending balance in period 1 being 7,500. So the next period cash flows are also 3 cash flows. So their probabilities will have to be considered along with the probability of the period 1 cash flow. So now if we move on to work the period 2 cash flows in the second requirement, it will be as follows. So we have to consider both months probabilities of cash flows, the period 1 and period 2 both, because we need to know the cash balance by the end of period 2. So let's check how it works. First, we will take period 1 closing balance, or opening balance at the beginning of period 2. So there can be 3 possible opening balances at the end of period 2. What are those 3 possible ending balances? One is 7,500, The second one is 3,500 from our previous working, and the third one is an overdraft balance of 2,500. So these are the three opening balances already possible at the beginning of the period 2. What was the probability of these balances? So we don't know that what is the actual amount going to be, but we know the probability. So the probability of 7,500 is 10%. Then the probability of the opening balance at the beginning of period 2 is going to be 0.6%, 60%, 0.6. And in the case of 2,500, the probability is going to be 0.3. Probability is going to be 30%, and 0.3 is in rate. So now what's next? Okay, next is the cash flows that will occur in period 2. Now see, if the ending balance by the end of period 1 is 7,500, then there are three possibilities in period 2, that either 7,000 will be received in period 2, or 3,000 will be received, or 9,000 will have to be paid in period 2. So now what will be the closing balance in the period? So the closing balance by the end of the period is going to be 7,500 was the positive cash balance, 7,000 will be received more. So it's going to be this much. In case that 3,000 are received and 7,500 are already present, then 7,500 plus 3,000 gives you 10,500 ending balance. And if a minus 9,000 cash flow occurs, or a payment occurs of 9,000, then the balance is going to be 1,500 overdraft by the end of period 2. Now, in the second case, if the opening balance is 3,500, obviously, if either of the three cash flows of period 2 occur, the balances will be different. So now there are going to be total 9 closing balances in all. Okay, students, please check the closing balances for the period 1. In the period 1, if you multiply the closing balances by the probability, you will arrive at this figures 7500 into 0.1, this gives you 750, right? Then 3500 into 0.6 gives you 2100, and 2500 into 0.3 gives you 750. So the expected value or the average ending balance is going to be 2100 by the end of period 1. Is it okay now? So there was a clerical error in putting in some formula over there, because sometimes I am in hurry, due to which sometimes it is there occurs some punching error over there. So that's why an error occurred over there. So sorry for any inconveniences due to this these plugging in amounts. So now it's okay now. So there were questions from Subhan Ahmed. So it's okay now, Subhan? And Sophia, Orlando, and Sheikh Imran. Thanks all of you for telling me about it. So sometimes I'm in hurry, so I didn't note it. Okay. So but remember, even in exam, it's very important that you show the workings, right? If you show the workings and your workings are correct, then definitely you get full marks, because main marks are of workings, right? But it won't be the case in MCQs. You need to be very accurate in case of MCQs. Okay, so let's move further. Thanks all of you. Okay, so moving ahead now. So now suppose in the period 2, the opening balance is 3500, and the cash received is 7000. Then 3500 plus 7500 7000 makes 10500. Then 3500 plus 3000, the next possibility, and the third possibility is 3500 minus 9000. This results in a negative balance, an overdraft of 5500. Now, what are the chances that the period 2 cash flow will be 7000? It is 0.3, 30%. What are the chances of the cash flows in the period 2 being 3000? This is 0.5. And the chances of the cash payments being 9000 is 0.2, 20%. So these are the probabilities. Now, if the opening balance in the period 2 is an overdraft of 2500, and then the period 2 cash flows 7000, 3000, and 9000 occur, what will be the ending balance? So 2500 negative plus 7000 leaves back 4500 at the end of the period. Then 2500 negative plus 3000 gives you 500 at the end of the period, and then 2500 negative plus a further payment of minus 9000 gives you 11500 overdraft. Now remember one thing, that what is the company's overdraft limit in this question? That also needs to be considered, that what's the company's overdraft limit. If you watch in the question, the very first line, ZAC company is concerned about exceeding its overdraft limit of 2 million. So remember, they just have an overdraft limit of 2 million. And if you look at the year 2 cash flows and the closing balances, so there are some times when the overdraft balance is exceeding the 2 million amount. Now, so it's 2 times it happens in case of 5500 minus and 11.5 million minus that the overdraft balance is exceeding 2 million. Okay, so that's been asked, that what is the probability of a negative cash balance or the balance exceeding the 2 million overdraft levels in part 3 and 4 of this part. So we'll calculate the probability over there. First of all, let's calculate the joint probabilities. So for joint probability, multiply both of these probabilities, multiply 0.1 by 0.3. So there are 10% chances that the cash balance at the beginning is going to be 7,500, right? So upon that 10%, that there is a 30% chance that the cash flow occurring period 2 will be 7,000. So now what's the chance? What's the probability? It is just 3% probability that the ending balance is going to be 14,500 positive. No, the opening balances are correct now. In the opening balance, we won't be taking an expected balance. Opening balance will be these balances. These will be the opening balances, because we are predicting these period 2 balances before the period 1 begins, right? So we won't be taking average balances, we will be taking actual balances, right? So we have taken like this: 7,500, 3,500 and 2,500. These were the 3 balances, and their probabilities were 0.6, 0.1 and 0.3. Now we are combining it with the cash flows like this, and then their probabilities. So now what is the probability of 14,500 being present at the end of period 2? So the probability is 0.3. Now how did get 0.03? 3%? How did we get? So 0.1 into 0.3 gives you 0.03. Is it clear now? Okay, Shahzad. So let's move ahead now. Let's calculate the joint probabilities. Keep multiplying the probability 0.1 by the 3 probabilities. 0.1 into 0.3, then 0.1 into 0.5 and 0.1 into 0.2. So this gives you the 3 joint probabilities for the period 1 and period 2 cash balances, and then multiplied 0.6 by 0.3. So this gives you 18% probability. Then 0.6 into 0.5 gives you a 30% probability, which is very high. The probability of 6,500 being the ending balance by the end of period 2 is 30%. And then 0.6 into 0.2, this is 12%. So remember, the chances, the probability of the overdraft balance crossing 2 million is 12%, which is very high. More than 10% is taken to be substantial. Okay, then the probabilities of the last set of 3 items. So there you go, you get the probabilities. Now moving on to the calculation of the expected value. So in order to calculate the expected value, we will multiply the closing balance with the joint probability, because now what are the probabilities relating to these closing balances? So there are 9 closing balances. Now one more thing, remember always that the total of all probability should be 1. Like if you add all these probabilities, the 9 joint probabilities, its total should be 1 if it's correct. So just check before you start multiplying it. So over here 30% into 0.2, so this gives you the total probability, which is 1. Likewise, okay, now let's start multiplying the cash flows. So now we'll multiply the closing balances by the joint probabilities. So the probability of the closing balance being 14,500 is 30%. So multiply is 3%, multiply by 3%, then the probability of 10,500 occurring at the end of period 2 is 5%, multiplied by 5%. So in this way, if we keep multiplying all the closing balances with a joint probability, we get the expected value by adding up all the figures in the last column. So in the last column, the average balance is 3,900. So closing balances multiplied by the joint probability gives you an average balance of 3,900. Obviously, the actual balance is not going to be 3,900. This is the average of all the 9 closing balances which we calculated by the end of period 2. So that's A1 and A2 done. So if we look at the average balances by the end of month 1, what we see that it is a positive balance. Again, at the end of month 2 or period 2, if we look at the average balance, it is 1,300. That's also positive. But if we look at the actual balances, there are 3 balances which are overdrawn, and out of the 3 negatives in the by the end of period 2, 2 of them, which are in blue shade, are balances overdrawn more than our limit. So we need to increase our overdraft limit in order to meet the payment obligations. Okay, so let's move ahead now. The next requirement is A3, the probability of a negative cash balance at the end of period 2. So what is the probability of a negative cash balance? So if you select these 3 green and blue shaded items, their probability. I am putting the probabilities of those negative balances, the joint probabilities of those negative balances into red numbers. So the chances of a negative cash balance, probability of at the end of period 2 is, add all of the three numbers in red, 2% plus 12% and plus 6%. So these make 21%. So 21% chances of overdraft balances. And then the last requirement is the probability of exceeding the overdraft limit. So in the period 2, there are two situations in which the balance at end exceeds the overdraft balances. So the probability of the overdraft balance exceeding 2 million is, pick the probabilities of the blue shaded figures, which is 0.1 to 12% and 0.06, which is 6%. So this makes 18% probability. So these are very high probabilities. In fact, more than 10% is substantial. Okay, so now obviously the company has to think about increasing their overdraft limits in order to meet these exceeding overdraft limit cash outflows, so that they do not make a default in paying these out, right? Okay, students, after this uh, there is question 5. Question 5 is a question uh, in which there are workings and things which we have already done. So I don't want to repeat. I want to go on to some new things and some more technical items. And that's why I'm going on to question number 6. I'll give you answer to question number 5 uh, in the worksheet when I hand over the worksheet to you people. But it's basically we have done all the workings which were required in question number 5 in previous questions. So I'm skipping it and I'm moving on to question number 6 so that we can do some new work in it. So please go through the question number 6. Please read the question 6 so that I can start in around 2 to 3 minutes time. I'll be starting question number 6. The first requirement of question number 6 is calculate the cash balance at the end of each month in the 3-month period. So this involves calculating a cash budget. And then calculate the forecast current ratio at the end of the 3-month period. So we'll be calculating a forecast current ratio, current assets divided by current liabilities. And for current ratio, we need to know the ending stock, the ending debtors, the cash balance, and the current liabilities, which we'll be calculating in that case. And then we'll be doing part C. So first of all, we'll be doing part A and B. So please go through the question so that we can start doing part A and B first. Okay, I've done some workings until you have read the question. So let's start doing this question, students. Let's first calculate the sales. So according to the question, the sales units in December are going to be 1200. In January, they are going to be 1250. In February, 1300 units. In March, 1400 units. And in April, they are going to be 1500 units. Okay, the selling price is going to be 800 in the month of December and January. And in February, the selling price is expected to increase by 5%. So it will become 800 into 1.05, which makes 840. And then it will remain same till April, 840. Okay. So in this manner, we arrive at the sales in thousands of dollars, which is $960,000 in December. Now, why are we calculating the sales in December? So we are calculating sales in December as we need to know the cash balance in January, the cash budget in January, that how much will be received in respect of sales in January. So as per question, the customers are paying within 1 month of sales. So as they are paying in a month of sale, so the December sales will be collected in January. That's why I have calculated the December sales. And what is my target? I have to calculate the cash budgets, the cash position for the month of January, February, and March. So obviously the December sales will be collected in January, the January sales will be collected in Feb, and the Feb will be collected in March. And then uh, why I have calculated the figures ahead? This is for production purposes. So I'll tell you about it when I calculate the production. So first let's calculate the sales. So the sales in the month of January is going to be 1 million. In February it is going to be 1,092,000. In March it's going to be 1,176,000. Okay. Now next, what about production? What they have told you about production in the question, they say that the production is to be undertaken 1 month in advance. Like the January sales will be produced in December. Like in January you are going to sell 1200 in January you are going to sell 1250 units, but when will you produce it? You will produce it 1 month in advance. So in December you will be producing 1250 units. Then the February sales will be produced in January. So this is going to be your ending stock as well, right? Ending stock quantity as well. Because if you produce the January products in December, so by the end of December you must be having it in go down to sell it off in January. And then in January you will be producing for the month of February. So the January production is going to be 1300 units, which will be sold in February. And the February production is going to be 1400. And the March production is going to be 1500 then. So this is the production cost. Now, the material to be used, each unit to be produced requires 2 units of material. So you will be needing 2500 units, 1250 into 2. In January, you will be needing 2600 units. In March, you will be needing 2800 units. And then in February, you'll be needing 2800 units. And in March, you'll be needing 3000 units. 1500 into 2, this gives you 3000 units. So I have multiplied the production units into 2 units in order to arrive at the raw material units consumed in each month. Now, what about the cost? Now, what they say about the raw material cost, that each unit of raw material will cost them $200 per unit. So you have to multiply 2500 units by 200. So if you multiply 2500 by 200 units, you get $500,000 cost in December, then $520,000 cost in January, $560,000 cost in February, and in March you get a cost of 600,000. So there you get the raw material cost. Now, raw material cost will be paid in 1 month's time. So when you purchase the raw material, you will pay it after 1 month's time. So the December's raw material payment will occur in January, and the January's raw material payment will occur in February, and the February's payment will occur in March. It will move like that. So 1 month there is a delay in payment of raw material. Now, so that will be seeing in the cash budgets, and that's why I have calculated the raw material purchases in the month of December, so that I can show the payments in the month of January. Okay, now the next is overheads. The cost of overheads are going to be 100 units, $100 per unit. So multiply the production quantity 1250 into 100 in order to arrive at the overhead cost. So the overhead cost is going to be 1,25,000 in December, and the overheads cost will be paid in the same month in which it is incurred. So January payment will occur in January only. Okay, so 130 will be the payment, 130,000 in the January. In February it is going to be 140,000, and in March it is going to be 150,000. Now we are in position to make the cash budgets. So our cash budget now, conversion cost is conversion cost includes your factory overheads and the labor cost. So they have given you combined regarding the wages and overheads. That's why I have used the word conversion cost. You can write like this, labor and overheads, or as well. It would be correct. Okay. Okay, let me take a question. There's a question from Rida. Why did you get units of 2500, 2600 and 2800? See, Rida, each unit of production requires 2 units of material. So I have multiplied the production quantity by 2. So you need to multiply this 1250, the production quantity, by 2 in order to arrive at 2500. And then you have to multiply by 2, and then this 2500 has been multiplied by the purchase cost, which is $200 of each unit. So we arrive at the 500,000 figure. Is it okay now, Rida? So it keeps on like that in next months as well. Okay. So in the cash budget question, first you need to calculate the cost correctly, and then we calculate the cash payments. So we have now in the first step calculated the cash, the expenses, and now we will calculate the payments, that when do the payments occur. So now making the cash budget for the month of January, month of February, and then the month of March. This is what required. So first we will take collections from customers. So the December customers are going to pay in the month of January. So now keep noting the receipts, the sales. So the December sales, although the sales occur in December, but the money will be received in January. So I've taken in January. Then the January sales is 1,000, but it will be collected in February as the customer is paying in 1 month's time. And then the February sales will be collected in the month of March. Okay. So that's collection from customers. Then according to the question, the business takes a loan in March, which is 300,000. So that also result in collection of cash. So I've taken it in the collection area. So now these are the receipts. First of all, I have taken the receipts. Now I'll be going on to the payments, budgeted payments. Okay. So in case of payments, we have to make 3 payments. One is for raw material. Second is for variable cost or the conversion cost. And the third payment is for machine. They will be purchasing a machine costing 4 lakh in March. So the raw material payments will be paid 1 month in delay. So the December's raw material payment is going to occur in January. So I'll be taking the December's amount in January. So December purchases are being paid in January, minus 500. Then January's payment in February, and the February amount of purchases of material 560 in February. Then, so please note, there is a tip regarding the cash budget. Please note that you take the cash payment in the correct period, right? Like if you take the payment in the wrong period, the cash budget will go wrong. The net cash flows will be incorrect for your period under consideration. Okay, now the conversion cost. The conversion costs are being paid in the same month when they are incurred. So the same month's cash flow will be taken, same month's expenses will be taken in the same months of the cash budget. So in case of January conversion cost, we will take the January's conversion cost 130. Then 140 will be the payment for overheads in February, and 150 will be the payment of overheads for the month of March. And then the machine cost 400. Right? So these were the payments. Now what happens after the receipts and payments? We get a net cash movement. So deduct all the payments from the receipts. You will get the net cash flow. So what is the net cash flow? 960 minus 500 minus 130. This gives you 330. Likewise, you get 340 in the month of February and 282 in the month of March. Then you had an opening balance of cash at the beginning of January, and that was 40,000 was the opening balance as per question. So now when you add the net cash receipts 330 to the opening balance, you get the ending balance. The ending balance of cash in January is 370, and this becomes the opening balance for the month of February. So 340 was the net cash generated, added to 370 at the beginning, gives you an ending balance of 710. This 710 becomes the opening balance for the month of March, and then ending balance 710 opening balance plus the net cash received 282 gives you 992. That's your cash budget for the month of January, February, and March. Now let's calculate the ratio. the current ratio. So in order to calculate the current ratio, we have to calculate the current ratio for the month of March. So the current ratio is current assets divided by current liabilities. So what will be the current assets and current liabilities? In this case, we have inventory, then receivables, and then cash balance, and then payables. Now, what is the inventory at the end of March, right? So the inventory at the end of March will be the production which we have already made in the month of March for the month of April. So how many units we have made in March for the month of April, because we are producing 1 month in advance. So we have produced 1500 units for the month of April in March, which are unsold. So this is going to be your inventory, and your cost per unit is 500. The production cost per unit is 500. Now how 500? Your conversion cost was 100 per unit and your material cost was 400. So the sum of the material and conversion cost gives you 500. So this gives you 1500 into 500, 7,50,000, the inventory at the end of March. Then the sales of March will be collected in April. Means all of the sales that occurred in the month of March will not have been collected in March. It will be collected in April. So that should be the receivable balance. So the sales of March will be taken as receivables, which was the sales in March was 1176. So 1176 will be taken as receivable. Then the cash balance in the March, as per our workings right now, according to the workings, we got 992, the balance at the end of March. And then the payables at the end of March, so obviously the material were purchased in the month of March, but the payment will occur 1 month delay in April. So the payments for the month of March in respect of material will be appearing in the payables, which are 600,000, and they can be seen from here. See, the 600 amount comes here. Okay, so now we can calculate the current assets divided by current liabilities. So the ratio is going to be the sum of all the current assets, 750 plus 1176 plus 992. $750 plus 1176 plus 992 divided by the 600 current liabilities. This will give you the current ratio. So it is 4.863, and if we take it to up to two decimal places, it becomes 4.86. What's the 500 in inventory working? Okay, let me tell you. It's not the inventory working, it's the raw material purchases. It is like this. See, look in green, the column in green. According to the question, the January's production will occur in the quantity to be sold in January will be produced in December, right? Then we multiplied 1250 by 2, as each unit of finished product requires 2 raw material units, and then we multiply 2500 by $200, which is the cost of purchasing 1 unit of raw material. So this 500 gives you purchases, right? So this purchases will be paid in January, 520 will be paid in February, 560 in March, and this much will be paid in April. So it comes into payables by the end of March. Is it okay now? Okay, so that's the predicted current ratio. And now we move on to the next requirement of this question, which was an important one. Cash budget is also important. So students, please go through this part. Acha, let me discuss part C as well. Assuming that fleet company expects to have a short-term cash surplus. Now, usually these cash surpluses are short-term. These keep on changing. Why is it short-term? Because suppose right now we are not in a busy season of production and sales, so we won't be needing much cash. But when a season arrives, so before the season starts, we have to start producing. So we have to spend more before the season to produce more. Right now we are producing more. In order to buy, in order to produce more, we need to buy material, labor, and all. We have to make payments, but it's not being sold right now. It will be sold after 2 months or 3 months time when the season arrives. So we are planning for the season, and at that time we will be receiving a lot of money. But right now we have to plan it and put in some money so that we can produce more and then sell at that time. So during these periods we will need cash. But when the season arrives and we sell a lot and we receive cash, we cannot invest all those cash for a long term, because again we know that a season is going to arrive and we will need cash. So it's better to put those money in a deposit account in a bank for a few months and not in any risky areas. Yes, I'll show you, Eddington. That's a payment area over here. Okay, so now as we will be needing money in a very short time interval, and if you put the money in a long-term investment, then it will be difficult for you to plan for the season production and pay your creditors on time. Then you have to borrow at a very high rate from the market. So it's better to place the cash, the surplus cash, in a short-term investment like in a deposit account in a bank, uh, even if it results in a less interest income from there, but it's less risky as well, because the deposits will give you a fixed amount of interest, and you will not lose any of your balance. But if you put the amount in a share, in an ordinary share, the price of it can fluctuate and you may make a loss if the prices goes down related to that share. So it's better not to invest in shares and go into a deposit account, a safer investment if you need those money in the business again. So the answer to this part is that what they were asking in part C, that should they invest the surplus amount which will be required in the short period of time into a stock market. So it's no, because if the prices of the shares go down, what happens that you will lose your investment amount, and then you will not be able to continue your business that effectively. You won't be, your production will be seriously affected. Suman, what happened that each material unit is costing $200. So you need 2,500 units of material. Multiply 2,500 by 200. You will get 5 lakh. So I have taken it in thousands. Okay. Eddington, how did I get the opening balance? Let me tell you. How did I get the opening balance? It's like this. See, 40,000 was given in the question. I picked it from the question, the 40,000 amount. It's from here, right? Then this ending balance becomes the opening balance in the next month. And this ending balance 710 becomes the, obviously 1 month's balance will become the opening balance in the next month. So 710 is the ending balance for February, but it will be opening balance for March. It's like this. Okay, let's continue with the next part. So students, please go through the next part's question requirement. I'll be starting in 3 minutes time. I'll start solving in 3 minutes time. Okay, students, I'm starting now with this part. What are they asking about is that the company is planning to give a 0.5% discount if people pay earlier. If the people pay earlier to the company in 30 days, which they are not right now doing, they are paying in 51 days. The customers are paying in 51 days. So due to the customers paying in 51 days, the company is having a huge asset, a receivable asset. Obviously, the asset should be equal to liabilities. They need funding for the asset. So they are needing more finances, and they are incurring a huge interest cost at 4% per annum on that overdraft finance. So they want to reduce the receivable balance and therefore the overdraft balance as well, and reduce the finance cost. Secondly, their competitor is also offering a 0.5% early settlement discount. Due to that, the customers are being attracted towards the competitor. So now they want to bring the customers back. So what happens that once they offer the early settlement discount of 0.5%, they expect that the sales will increase by 20%. Their credit sales, not the cash sales, their credit sales will increase by 20%. Their credit sales is 80% of the total sales. So if the credit sales increase, they will be able to earn more profits as well, which is 10% of their sales. So they will be able to earn more profits. So one of the benefits of extending the 0.5% discount is that they will be saving some interest expense. Secondly, they will be earning some more profits. And thirdly, third benefit is that they will be saving some bad debts as well. As per question, they say that usually they incur a bad debt expense uh, which is 0.5%. Let me show you in the question. You'll be seeing some highlighting and some shading, some circling in blue color, and that's 0.5% bad debts. those bad debts will reduce. 0.5% bad debts. These bad debts are expected to decrease due to offering the early settlement discount. As the people will hurry to pay in 30 days time, obviously some people will like to save their 0.5%, so they will pay, and the bad debts will reduce. So let's make the working of how it occurs. So the bad debts will reduce. Then what happens that they will have to give a discount. So due to giving discount, they will receive less money, so they will incur an expense, a discount expense. So, and plus their administration cost will increase by $35,000 per year. So there are two types of costs that will be incurred. So now, first of all, let's calculate the cost. That's the simpler part, and then they will be calculating the income portion. So due to offering 0.5% early settlement discounts, administration cost will increase. So administration cost will increase by 35,000. Then let me take in minus. Then their discount expense will increase. So the discount, what will be the discount expense? So the discount expense is going to be 28,800,000 multiplied by 5% multiplied by 75%. As 75% of the credit customers will avail the discount. Now, where did I get 28.8 million? I'll tell you. So the discount cost becomes 108,000. Okay, now how did I get this 28.8 million? First of all, let me total the expenses that will increase due to offering this 0.5% discount. So the expenses will increase by 143%, and then increase in profits. So by how much the profits will increase? So what's happening right now, that the sales now is 30 million. Right now the sale is 30 million without any discounts. And then the credit sales is 80% of the total. So if we take 80% of the total sales, this makes 24 million. Now, what they say, that the sales will increase, revised sales. So the revised sales will become 120%. It will increase by 20%. So if we multiply 24 lakh by 120%, the sales is going to become 288, 28,800,000. That's how I got that 28.8 million. Right? So this is how I got 28.8 million, the revised sales. Then by how much the profit will increase? So the profits is going to increase by, now as the sales will increase, the credit sales were earlier 24 million, right? and now it will become 28.8 million. So due to the increase in sales, the profits will increase by 10%. The company is earning 10% profit right now. But if in the question they have given you contribution, go for the contribution, because the fixed cost will not change, right? So only incremental cost should be considered. The sales is incremental and the variable cost is incremental. Fixed cost should not be considered. But in this question, they have not told you the variable cost and the sales, and they have not told you the ratio of variable cost to sales or contribution ratio. That's why I'm taking the ratio of profit only. So the profits increase by 480,000. The sales increased by 4.8 million multiplied by 20% gives you the increase in profit by 480,000. Now, what happens next? They managed to save the bad debts, decrease in bad debts. That's also saving. Now, how much bad debts will be saved? Right now, they will be incurring bad debts on 24 million. And the bad debts are 0.5% on 24 million, which makes 1,20,000 is the current bad debt. Now, what will be the revised bad debts? The revised sales is going to be 28.8 million. And then on this amount, the bad debts rate is going to fall to 0.375%. So now the revised credit sales becomes 28.8 million and the bad debts will become 0.375%. So 0.375% of 28.8 million becomes 108,000. So your bad debts is now increased. The bad debts have now decreased by how much? 12,000. So you save 12,000 from the bad debts. The difference between 120,000 and 108,000. Yeah, you're right, Eddington. I have taken it as 28.8 million. Okay. So now the next saving is decrease in financing cost. Cost of financing debtors. As we calculated in the previous question, OLNED as well, that the cost of financing will decrease. So now first we need to know that what will be the debtors amount in past and what it is going to be after the proposal is undertaken. So let's take the receivable, existing receivable. So the existing debtors is 24 million is your sales. So people are paying within 51 days right now. So multiply by 51, divide by 360 or 365. So as per question, they have told you that assume the year as 360 in this question. So the existing debtors are 24 million into 51 days divided by 360, this makes 3.4 million. This is the current balance, and the revised debtors is going to be revised debtors will be categorized into two items, because out of 24 million, 28.8 million, sorry, 75% of the customers are going to take the early settlement discount, right? So if they take the early settlement discount, they will be paying in 30 days rather than 51 days. So 30 divided by 360. So the receivable, the remaining portion, 28.8 million into 25%, people will keep paying in their old habit, which was of 51 days. They won't claim the early settlement discount. So there you go. You get the revised debtor balances, 1,800,000 and 1,020,000. So now it becomes the revised debtors become 28,20,000. So the debtors have gone down by how much? So decrease in debtors is 28,20,000 minus 34 lakhs. This is the decrease in debtors amount, and on this much amount decrease in debtors, this has decreased by 5,80,000. The company will be able to reduce their overdraft as well by 580,000. If your assets decrease, your financing will also decrease. If you need less assets, you will need less financing as well. Eddington, what happens that, see, if you have an asset, just imagine about the balance sheet. If you have an asset on the asset side of the balance sheet, you will be also having some balances on the liability side or the equity side as well, right? So if you have a 400,000, suppose 400,000 receivable, then you should be having a financing item also, a liability item on the equity side, right? Now, when your balance of receivable goes down from 400,000 to 300,000, then your liability side will also go down. And if your liability decrease, you will save some interest expense. So it's in that manner we are talking about this. So if your receivables decrease, obviously your liability side will also decrease. Secondly, why we are talking about overdraft? Usually longer term assets need a longer term finance, and the shorter term assets need a shorter term finance. So receivable is a shorter term asset. So we have financed it, we should have financed through the overdraft. So it is 4% overdraft rate, which we are saving in this case. So as the receivable balance goes down, our liabilities, means the short-term liabilities goes down like overdraft, and we'll be saving some financing cost over it on the overdraft balance. So that's what we are doing. So on 580,000 we'll save 4%. So that's going to be 23,200. So now if you add up the income items in here, you get a saving of 512,200, but just a cost of 143,000. So in net, you save a lot over here. So your net incremental income on accepting this proposal is going to be this much, 512,000 minus 143,000, the incremental cost. This gives you a saving of 372,000. Therefore, the proposal is financially viable. Okay, students. Now I'm stopping with working capital requirements over here, and now I'm moving on to the risk management. As I believe that I need to explain some risk management items like money market hedge and the forward contract, which is more important to practice on. So I'll be going on to that now. No, discount is 108,000. Subhan, it is yeah, I'll be sharing the file. Don't worry, I'll be sharing the file on the group by either tomorrow evening or on Sunday, because I have to do some work on it. I have to place some answers where I have left some parts of questions there. When I'll put in those answers, I'll share the file with you, right? Don't worry. Welcome. Okay, Suman, you were asking about the discount, no? So discount has been calculated to be 108,000. It is 0.5%. It's not 5%. So it makes 108,000. Okay. So now moving on to the risk management portion. Starting with the risk management portion now. So before we start the risk management portion, you can take a 2-minute break. I'm getting silent for a 2-minute time, and you people also can get some fresh, drink some water and all, and then we'll start doing the risk management portion. Yes, Tahira, the admin will give you the number, and I will send you the link afterwards if you contact on that number. Okay, students, let's start now. Let's continue with our. Okay, the break is over now. So let's start now. So discuss the difference between transaction risk, translation risk, and economic risk. See, what is the translation risk? I'll just tell you verbally so that I can move on to the more important portions first. Translation risk is something related to accounting. Now, if you have a receivable or a payable or a foreign currency asset in accounting in the balance sheet, and the foreign currency rates are changing, so according to IS 21, you have to change the receivable and payable balances or the foreign currency monetary assets. So the risk that the balances, the payable balances will increase or the receivable balance will decrease, resulting in losses, is known as translation risk. So translation means, okay, actually the risk may not occur, it may increase now, and after some time it may again decrease. The loss occurs, and that the currency again gets better. So you may not incur a loss in actual, but in financial statements, sometimes we may have to record the losses. So that's known as translation risk. So it's related to financial statements and accounting work, not in actual. But suppose if you enter into a contract with suppose US supplier, and he's asking for $100,000 in 3 months time, and the dollar strengthens, then what happens? This risk occurs, the transaction risk. So if you have already entered into a contract and you know you have to settle in a foreign currency in future, either you are receiving money in a foreign currency or you are going to pay some money in the foreign currency in in a few days. So in that case, if the foreign currency rates change, and in case of receivables, if the foreign currency depreciates, then you will be a loser. You will make a loss. And if in case of payment, the foreign currency strengthens, you have to pay more. So you will make a loss. So this is known as a transaction risk. And then there is an economic risk, the third one. Now, what's an economic risk? Economic risk is the risk that suppose you have a branch in a foreign country, and all of the operations and the assets are in foreign currency. Yes, wait, Aisha, I'll tell you. Suppose you have a branch in a foreign country, like you have uh, suppose a subsidiary company or a branch company in United States, and you have made investments in dollars, and you keep on bringing in and taking money to US. So over there, what happens that you will be receiving cash and paying cash to the United States, investing their money. So due to the exchange rate changes, even if you have not entered into a contract, but you know that you are going to have cash flows, cash receipts and payments with that country, so your cash flows may change. So that risk is known as an economic risk due to investment in some foreign country. And the translation risk, I repeat again, that it is to do with the financial statements. In the financial statements, you have to change the receivables and payables amount, which is in foreign currency, if the exchange rates change. So the losses and gains arising on that will affect your financial statement, that is known as translation risk. Okay, so that's about the risk. Now let's move on to the calculation portion of this question, Nedwin. Now, the next part is calculate the expected sterling receipts in 1 month and 3 months using the forward market. Now, as per question, forward market is used to protect the company from adverse exchange rate movements in the foreign currency. So look first that before you use any hedging method, you need to first net off the payments. Look, in this question, you have two transactions in 1 month's time. You have a receipt and you have a payment. So always first net the receipts and payments, because if you hedge them, both of them separately, there is a cost of hedging. So you will be paying cost on 380,000, a separate hedge on 240,000 and a separate hedge on 140,000. So you'll be incurring a cost on 380,000. So you can't have a separate hedge. You know that you are going to receive 240,000 and paying 140,000. So you just need a hedge on 100,000 only, because you will be receiving 240,000, out of which 140,000 can be easily paid. So don't need to purchase the foreign currency. You just need to hedge the 100,000 which is excess, the receipts amount. So now you need a protection against 100,000 receipts of foreign currency, that is dollar. And this company is a UK based company. So the local currency is sterling and the foreign currency is dollars. So they are expecting a exchange rate movement to occur on $100,000, against which they need a protection, and they are getting a forward contract to do this. So second thing to remember, that when you are using a forward contract, now we are talking about 1 month. So when you are talking about 1 month, you will take a 1 month forward contract. Now which rate to use? If you are talking about receipt, take the higher rate. Always take the higher rate. So what about the higher rate? You have been given 1.7829 plus minus. So if you plus 0.03, you will get a higher rate. And if you are paying, take a lower rate. For receipts, take a higher rate, and for payment, take a lower rate. Remember this. Remember HR, higher rate for receipts, and obviously the opposite one for the payments. So now what happens? First of all, 1 month. We talk about 1 month dollar receipts. We will net it off first. 240,000 are the receipts in dollars and 140,000 are the payments in dollars. So this gives you a net amount of $100,000. Okay, now your currency is sterling, so you'll have to convert it in sterling. So what to do? You need a sterling amount, sorry. The sterling receipts in 1 month. You are facing a risk that the spot rate will change and you may incur a loss. So you enter into a forward contract and you get the rate fixed in advance. So you get the rate fixed in 1 month advance. So now you know for sure that your 100,000 are to be converted at what rate? 1.7832. Now whatever be the spot rate, you are going to convert in this rate, right? So take the higher rate, the 1.7832, which occurs as follows. Now how did the rate occur? Now this occurred like this: 1.7829 plus 0.0003, the higher rate. This gives you 1.7832. So in case of receipts, you'll be using this rate. Now this gives you the local currency sterling amounts, which is 56,079. So this is now fixed. Now your exposure is over. You don't need to worry about what the spot rate will be. You will be getting this much amount in any case. due to your forward contract. Okay, now let's talk about the 3 months receipt in forward contract. We are talking about forward contracts. First, by forward contract, we go to a bank or a foreign currency dealer and ask him to give us a rate for future. Yes, Daniel, you will get the whole solution document. Don't worry. 100,000 is net. Rida, they are going to receive 240,000 in 1 month's time, and they are going to pay 140,000. So deduct 140,000 from 240,000, you will get 100,000 net receipts. So first, see, I've given the working. 1 month receives 240,000 minus the payment 140,000 1 month's time. Now we'll talk about 3 months. Let's talk about 3 months. So in 3 months, they are just having only one transaction. See, this transaction is 3 months, and it is an expected receipt of 300,000. So again, now which forward contract will you use? You will use a 3-month forward rate, which is 1.7846 plus 0.0004. As now again it is a receipt, we'll be using the higher rate in this case as well. So 3 months foreign currency receipts. The amount is $300,000, and the local currency is sterling. So what are going to be the sterling receipts in 3 months time? So they are going to be 300,000 divided by 1.7850, and this will be calculated as follows. Pick the 3-month forward rate, which was 1.7846 plus 0.0004. So it gives you 1.7850. So this is how you get, right? So this is your forward contract working in yellow, and in golden you get a 3-month forward contract. In yellow you get 1 month contract, and in golden you get the 3-month forward sterling receipts, the local currency receipts. Okay, now the next requirement is money market hedge. Calculate the expected sterling receipts in 3 months using a money market hedge. Now what is a money market hedge? A hedge which has been built using borrowing and lending. If you make a hedge by borrowing and lending of foreign currency and local currency, then that is known as a money market hedge. Money market is basically involved in borrowing and investing of money. So we are talking about the money market hedge. Now how will we make a money market hedge for receipts in 3 months time? This is what required over here. So you need to know the expected sterling receipts in 3 months time. You have to calculate the expected 3 months receipts. But what you are going to receive, you are going to receive a dollar amount of 300,000 in 3 months time. So a money market hedge. Now let's start doing a money market hedge. Yeah, we will do both, don't worry. In this question we are first going to go for money market hedge for receipts, and then we have another question as well in our handout today, and we are going to definitely do it, the payments one. So we'll do the both. So you will be having a solution for both, don't worry. So let's first do the money market hedge. For FC stands for foreign currency receipts. Now look what to do. I am telling you the strategy about the money market hedge for receipts. So first what you do, you will borrow. Now you have to learn this. Borrow dollar now, or borrow the foreign currency now. Dollar is basically the foreign currency. So I will write foreign currency dollar now. Now how many dollars to borrow? What's the formula for it? The formula is you will take the foreign currency receipts, which is 300,000, and divide the receipts by 1 plus R. R is the rate, right? I'm writing the rate. If you are borrowing, you will be using a RD. RB, sorry. RB stands for rate of borrowing. R is the rate and RB is rate for borrowing. So how many funds you will be borrowing? This step tells you how many funds you will borrow. So take the receipts, foreign currency receipts, which is 300,000. Divide this by 1.0135. Now how did it get 1.0135? It is like this. Look, take the RB. RB is the rate of borrowing, right? And remember one thing, that what are you doing? If you are borrowing, use a borrowing rate. If you are borrowing, use the borrowing rate. If you are lending, use the lending rate. Simple. So they have given you two rates in the question. As per question, you can find two rates: the borrowing rate and the deposit rate, right? Deposit is the lending rate. So you need an RB. So the RB over here is the borrowing rate, and for what currency? The dollar currency. What currency you are borrowing now? You're borrowing the dollar, the foreign currency. So you're taking this rate, 5.4%. Now 5.4% is for a year, remember. And in how much time we are going to receive the money? In 3 months time. So what you have to do, 0.054 is the rate, 5.4%, divide this by 4. And then we need 1 plus RB. So the 1 plus RB becomes 1.0135, right? So this is how we got 1 plus RB. And the foreign currency receipts are 300,000. So this is the amount we are going to borrow now. So it is, the amount to be borrowed is 296,004. This is our first step. So do you remember now what you are going to do? First, you need to borrow. Now you will not borrow 300,000. You will borrow the present value of 300,000. So this is basically a present value calculation. So 300,000 divided by 1 plus R gives you the present value. 1 plus RB. Why RB? As you are borrowing, you will be taking the borrowing rate. And as you are borrowing the foreign currency, you are taking the borrowing rate of dollars, the foreign currency, right? So this is how it works. Now, after borrowing, the next step, once you borrow the dollars, right, you need sterling. Convert the dollar amount into the sterling amount by going to the foreign currency market. So convert the foreign currency amount into the local currency amount, and the local currency is sterling. Okay, now how will you convert? Again, take the amount 296,004 and take the higher rate, but this time not the forward rate. We are not using the forward contract. Take the spot rate, the higher spot rate. So spot rate, see, we are talking same about receipts. In case of receipt, you are going to take the higher rate, HR, higher rate, higher in case of receipts. So higher spot rate should be taken, and the higher spot rate is 1.7820 plus 0.0002. So 1.7822. So we take the higher rate, but higher spot rate. You have to convert it immediately. So higher spot rate is 1.7820 plus 0.0002. Use this rate. So now once you divide it by this rate, because you are selling the currency, you will sell high and you will buy low. This is an indirect quote. That's why. Right now, please let me explain the hedge first, then ask about this. Okay. So now what happens? So right now you remember that when you are receiving foreign currency, you will be using the higher rate, right? Earlier also I used the higher rate only. Why we divide the borrowing rate? The borrowing rate is for a year, and we are going to receive the money in 3 months. That's why we are dividing it by 4. You can say that you can do it like this. You can do it like this, that instead of dividing by 4, you multiply into 3 divide by 12. So you have taken a 3 months rate. So it will give you the same answer, 0.054 into 3 upon 12, right? Okay. Now the converted amount becomes 1,66,089. Now this is your sterling amount. This is your sterling amount. Okay, now you get the sterling amount. Now what we will do next, that you will borrow. You had borrowed the foreign currency amount 296,004, and then you got converted it into the sterling amount, and now invest this much amount. Invest, next step, invest the local currency amount into and receive local currency interest and principal in 3 months. This will be your sterling receipts. So what you do, that invest this 166,089 in a bank account right now, and for a 3 months time. And if you invest for a 3 months time, you will receive 2 things after 3 months time, the principal amount and the interest amount. So how much will be that receive? The receipt amount will be amount in sterling in the local currency multiplied by 1 plus, what rate should it be? It should be a lending rate or the deposit rate. So the rate should be rate of lending, RL. Take the lending rate. So again, I do a working of RL now. So the working of RL is, now what currency you are lending? What currency you are lending? You are lending sterling now. So you will be taking a deposit rate now in this case. So the deposit rate for sterling should be taken 4.6%. So how it will be calculated? So 0.046 multiplied by 3 divided by 12, again for 3 months. So this is the RL. Now, what will be 1 plus RL? 1 plus RL is now 1.0115. So multiply the amount 166,089, the sterling amount, which you got from the foreign currency dealer, by 1.115. Now, this is the amount which you will receive in how much time? In 3 months time. And this is your sterling receipts. So this makes 167,999, or approximately 1,68,000 is the amount which you receive over here. So this is your sterling amount which you receive. So this is your answer in the last step. This is what sterling receipts they are asking for. RL is the rate of lending, L for lending. Now, as you are investing, that's why you are taking a lending rate. Now, if you go to deposit some amount in the bank, bank will quote you a different rate. If you borrow, the bank will quote you a different rate. If you ask for a dollar currency, they will quote you a different rate. If you ask for a sterling currency, they will quote you a different rate. So that's why over here we are using the Shirti, it will be opposite. If you are borrowing, you will if you are paying money in foreign currency, you will be taking the lower rate. You're right. Yeah, we are depositing pounds, Karthik. Lending and deposit is same thing, na? We are lending means we are depositing it somewhere. Yeah, 1 plus RL equals to 1.0115. You're right. It's 1.0115. It may have occurred some clerically. I told you earlier as well that sometimes what happens that there is some punching error when you're using the keyboard very fast. It happens sometime. Okay, so that's your answer for 3 months money market hedge. Now, money market hedge, I use 3 steps. Let me shade. First, I borrowed the money. Now, what to borrow? This is given in. This has been given in blue, the amount of borrowing. Then I converted using the higher spot rate into the local currency. This you can see in light maroon. And then I invested the money. And by investing it, after 3 months, I received the money along with the interest. And that's my receipt. This you can see in golden color. The answer is in red, which you will present. Now, let's do the payment work. Okay. Yeah, it is whenever there is a foreign currency receipt, Rida, you always have to do like this, right? So remember the rule, BCD. It is ABCD, na? Remember BCD. B for borrow, C for converting, and D for deposit. So first borrow, then convert, and then deposit. This is for receipts. Money market hedge for receipts. BCD rule. Okay, now let's move on to the payment rule. So I'm moving on to another question for the payment rule. In order to discuss the money market hedge first, I'm skipping some questions. I will come back onto the other questions again. But let's first do the money market hedge for payments, right? So the question is noon. Students, please read this question. Question 3, noon. I'm giving you around 3 minutes to read it, and then I'll start doing this question. See, in this question, they are going to pay. I'm just highlighting a few points, then you will be given some time to read it. See, one particular payment of 3 million in Flyland francs. Flyland franc is a foreign currency for Noon company. Noon company's native currency, Noon company is situated in Centerland, and its own currency is Centerland colon. Centerland colon is their local currency, and the foreign currency is Flyland francs. So now what they want, they first want a forward market hedge, and what rate will we use? The lower one, because this is a payment. So in case of payment, you will be using a lower rate, this one, 6.321. And then they are asking for in the next requirement C. Check the requirement C. They are asking for a money market hedge. So what is the cost in the money market hedge? In case of a payment, you will incur a cost, right? And in case of a receipt, you will receive sterling, the local currency, as we did in the last example, right? So first go to the question, then I'll tell you the strategy, how to do it. I'm scrolling back to the question in a minute. So scroll back to the question. Okay, please go to the question now. Yeah, I'll be doing the complete working, Rida, don't worry. Okay, students, I'm starting doing this question now. First of all, the forward market hedge. Now there is only one payment. This is for payment. So the forward market hedge, we will calculate the CC payment, the local currency payment, in the payment is going to occur in 3 months time. So what I'm going to do, the payment amount is 3 million, and divide with the lower rate, 6.321. This is the lower rate, and this gives you the amount, which is 4,74,608. This is in CC. So that's the forward market hedge payment, right? Use the lower rate, lower forward rate for payment. Okay, now this was simple. You get the forward contract amount, and the correct answer is option B is the correct answer. Now, the more important one is the money market hedge. Setting a money market hedge will be more important. So now let's move on to the money market hedge. Okay, let's set a money market hedge, which is as follows. Now what you are going to do, okay, money market hedge for foreign currency payments. What you are going to do first, in this case, we will move in the reverse direction. In the last case, remember, we were receiving money, so we borrowed. In this case, we are paying money, paying foreign currency. So we will invest foreign currency now. Invest foreign currency now. Now, how much investment will occur, right? You need to remember the formula. So take the foreign currency amount, foreign currency payment amount, which was 3 million, and divide it by 1 plus what? RB or RL? RB or RL? RL will be the rate. Why? Because you are investing. So in case of investment, use the lending rate or the deposit rate, RD or RL, right? So in this case now, what is RL? For RL, which currency rate you will use? You will be using the rate for the flyland francs. Use the rate for flyland francs, and the deposit rate will be used because you are lending. You are in the phase of lending, so you will be using the deposit rate. Use this rate, 13.5%. This rate belongs to the foreign currency. As you are talking about foreign currency, flyland. Now, again, how many months? You have to go according to the months. So as it is 3 months time, so 0.135 divided by, let's move like this, multiplied by 3 divided by 12. So this gives you 0.03375. 0.03375. Then 1 plus RL will be 1.03375. There you go. Now divide 3 million by 1.03375. By doing this, you get an amount which is 2902 056. This is the amount you get. Now this amount is the foreign currency investment. This is in flyland francs, FF. This amount is the amount you are going to invest right now. Now, how will you invest? You can't invest this amount. From where did you get this amount? You first have to convert the sterling into this much amount. You will need sterling. Obviously, you will be having sterling, and you will convert the sterling into the flyland francs and then invest, right? So what happens? First, convert local currency into the foreign currency amount. How will you do? Use the amount to be borrowed in the first step. Sorry, amount to be invested. I will take a foreign currency amount to be invested. Take this amount and divide it by what rate? You are making a payment, lower spot rate. In case of receipt, you use a higher spot rate. Okay. So now dividing 2902 056 by 6.170. This is the lower spot rate. So doing this, you arrive at 470349. Now this is your amount in your local currency, CC. What's next now? Now, as you have converted sterling into the flyland amount, you needed 470,349 CC amount. First, you converted 473.49 CC into 2902,056 flylands, and then you invested in to a deposit account, right, at a rate of 13.5%. Now what happens next? How did you get the sterling amount? You'll have to borrow the sterling amount, borrow the local currency amount, and make the repayment together with interest, and both of these will take in local currency. So now you will repay the amount that will be borrowed now. So what you do over here, just mark these letters. First, what did you do? You found the investment amount. First, you found the investment amount. So remember the word, the letter I. Remember the letter I, invest foreign currency. Then what did you do? Convert into local currency. Then borrow. So now it becomes ICB. Remember ICB, invest foreign currency now, divide the foreign currency by the 1 plus RL, then convert using the lower spot rate into local currency, and then borrow the local currency amount and pay it together with the interest in 3 months time. So what happens, that take the local currency amount from the previous part and multiply it by 1 plus what rate now? It should be RB, because you are borrowing. And which currency? The local currency rates will be used. So use the RB, borrowing rate, which is the borrowing rate of colons will be used in this case. So the borrowing rate of colon is 8.1%. So 0.081 multiplied by 3 divided by 12. So if it's a 6 months money market head, then use 6 upon 12. If it is a annual rate, then you can use the rate directly, 8.1%. So now the local currency amount 470,349 from the second step, multiply it by 1 plus RB. Yeah, it's opposite, Rida. You're right. So as I said earlier, money market hedge means making a hedge through borrowing and lending. In case of, in case we are receiving foreign currency, borrow first. BCD rule. In case you receive foreign currency, borrow first, and then it ends in investment and payment, investment and income. And in case of you are going to paying foreign currency, invest first, and it ends at the borrowing stage. So 1.02275. Multiply it by this amount and you get the answer. So the answer to this is 479,874. Now this is in your local currency amount. This is what you are going to pay in 3 months time. This is your answer. Okay. No, you will not use a lower borrowing rate, lower spot rate. Borrowing rate will be belonging to the currency in which you are borrowing. So you are borrowing in local currency. That's why you have used the local currency rate. Yes, Daniel, you will get the local the solutions by either tomorrow night or in the next class on Sunday. Sorry. Okay. So let's move on to the on other questions now. So have you done it? Okay. So let me repeat again once more. See, money market hedge, foreign currency payment. First step in blue. What did you do? You invest foreign currency payment. Divide foreign currency payment amount divided by 1 plus RL, the lending rate because you are investing. Then the second step, convert the amount in the blue into the sterling. And then borrow this much amount. And you have to pay together with the interest after 3 months time. This is given in light maroon. So 479,874 will be the amount which will be paying in 3 months time. So that's the answer to this money market hedge for payment. So both have been done now, right? Okay, now let's move on to the other questions now. I'm going back again on question 2, starting with question 2 now. Okay, so question 2. Now students, I want you to calculate this requirement A. I will share it, Asma, in the group, right? I can't do it now. Okay. So Mallet Company requirement A. Now you can do this. I'll give you the answer only. Can you plus can you please put on a 3 minutes time and do this part A, the money market hedge? So students, that's my answer to this part A. 117004 AUD, Australian dollars. Okay, students, I hope you have done. Okay, moving on to the part B. Which of the following relationships suggest that current long-term interest rates can be used to predict future short-term interest rates? So for this, the correct answer is option A. Expectation theory is basically way which helps us to predict the short-term rates on the basis of the long-term rates. So Fisher effect helps us in calculating the nominal rates. Interest rate parity helps us calculate the forward rate, and purchasing power parity helps us calculating the future spot rate. So it's expectation theory which is the correct answer. Now, what's the next? What is the 3-month forward exchange rate to 4 decimal places? See what they're asking. Forward exchange rate. Yeah, you're right. It is 843. Huh? Again a punching problem. Huh? Please excuse me for these punching problem because sometimes it occurs due to the finger problem on the keyboard. Okay, so next move on to this is a receipt, so it's going to be a higher rate, but over here you have only given the one rate only. Okay, now the answer comes on. Now let's check what's 3-month forward. What they are trying to ask over here, they are trying to ask a forward exchange rate, and a forward contract rate. They are asking about a 3-month forward exchange rate. So how will you find a 3-month forward exchange rate? So the formula for this is you have to use the interest rate parity over here. Interest rate parity helps you. No, not in this case. I was talking about earlier case, Rida, not in this case. Someone was asking me a question. I answered that question to him, right? Not about this. Now you need to know the forward exchange rate over here. So forward exchange rate can be found by using interest rate parity theorem. So there is a forward rate formula using interest rate parity theory. We can calculate the forward rate. Now the formula for forward exchange rate is equal to the spot rate. Now we'll take the spot rate and then multiply the spot rate. Now remember, the forward exchange rate depends on the interest rate difference of two countries, of two currencies. So in order to know the forward rate of exchange, you will multiply the spot rate by 1 plus the interest rate of the foreign currency. You will take the interest rate of the foreign currency. This is not minus, huh? This is dash. Okay, let me remove it from there. Make a bracket there. Otherwise, you may take it as a minus. So, and divided by 1 plus interest rate of the local currency. This is the formula for the interest rate parity theorem to predict the forward exchange rate, right? Now, in this case, the dollar was the foreign currency and the Australian dollar was, US dollar was the foreign currency and Australian dollar was the local currency. So over here, you can predict both of the rates over here. If they ask for the lower rate, you can use the lower rate. If they ask for the higher rate, you can predict higher rate as well from this formula. Doesn't matter. Over in this question, they have just given you one rate, right? So actually what happens that the rate is given like this: 7.45 plus 0.2 minus 0.2. So this is to predict that 7.452. Then plus minus element is something to be done afterwards, right? Did you get it, Kamran? Okay. So the spot rate in this question was 0.7233. Multiplied the spot rate by 1 plus 0.033 divide by 4. Why divide by 4? Because that rate was for a year. We are going to take the rate for 3 months. And then divide by 1 plus 0.029 divide by 4. Divide by 4 means we need a rate for 3 months. That's why we have divided by 4. Or you can take 3 upon 12 as well. So this gives you a rate, a forward rate, which is 0.7240. Now you can make the lower and higher rate by adding 0.02 or 0.002 or 0.002 plus minus whatever is the difference in the buying and the selling rate. So you can make it afterwards. So this is the rate now. So that's the answer using the interest rate parity theorem. Please remember these formula, like you will remember the money market hedge and the receipts and payments and the forward contract. Likewise, you'll be learning this interest rate parity used to predict the forward exchange rate. And upcoming is a purchasing power parity as well in a future question. So look at it in the next question, in question number 3, noon 1. Okay, let's move to the next one now. So the next question is, one risk that a company which exports and imports may face is that of exchange losses when accounting results. So as I said earlier, when your accounting results, what risk will it face? It's a translation risk. It's not an economic risk. It's not a political risk. It's not a transaction risk. It's a translation risk, which occurs when you are translating it. It's not transaction, it's translation. Transaction risk occurs when you are settling the transaction, you are making receipts and payments in actual at that time. Okay, you are right, Orlando and Aisha. Okay, so the correct answer to this one is D. Okay, moving on to the next one. Requirement E. So why is a currency option? Remember currency option. What is currency option? Option means a right to buy a currency, but you are not bound to do so. You're not bound to purchase it. Yes, Sophia, you are right. That's correct. You'll do like this. Once you find the rate, then you put the plus minus element. Okay. So what's the correct answer to this is that in case of future currency option, you may not buy the currency, because if it seems that you are not making a good profit, you can drop it down. You may not get the contract, and if you look at good that it makes a profit to you, you can accept it. So the correct answer is D. Future options are never cheaper, they are always expensive, because the option writer is taking too much high risk, so you will sell it at a very high cost. Okay, now Noon Limited. We have already done part A of Noon, and we have done part B as well. No, we have not done part B. Let's go for part B first. What should be the answer for part B? Which of the following relationships attempt to explain the difference between forward and spot rates? Forward and spot rates of exchange rate between the two currencies. We have done just now. So it's interest rate parity theorem. This helps you to predict the forward rates based on the spot rates. So it's interest rate parity theorem. The correct answer is C. The formula we know now. You remember the formula? The spot rate multiplied by 1 plus interest rate of the foreign currency divided by 1 plus interest rate of the local currency. Okay, we have done part C. Let's move on to the part D. So please go to the part D and tell me what you will say about these four statements, true or false. Answer to this is all are correct. All statements are true. Amounts and periods are standardized. So in futures, interest rate futures, all contracts are standardized contracts. When you go to the future market, all contracts are standardized. They are of 125,000 or likewise. They are fixed amounts. Then the next point, they are legally binding contracts. Obviously, it's a future contract, so binding contract. They can be bought and sold on a secondary market. Yes, obviously, we can buy and sell it. Anyone can buy and sell it for speculation purpose, like shares. We can buy and sell futures contract. That's correct. They can be used to hedge risk and to speculate on interest rate movements. That's also correct. Some people use it for hedging, reducing the risk, reducing the losses, and some people just used to play speculation. So all are correct. Okay, now students, the last one, E. This uses the purchasing power parity theorem. One of the relationship is interest rate parity theorem. This question asks for the purchasing power parity theorem. Now see, they are asking for inflation. If inflation is currently running at 3.8% per annum in Centerland, what is the implied inflation rate in Flyland? So you need to know the inflation rate in this question. So let me tell you about purchasing power parity theorem. helps you in finding future spot rate. If you want to know the spot rate of a country's currency in 3 months time, you can use the purchasing power parity theorem to find the future spot rate using the current spot rate and the relative inflation rates in the local and foreign currency. You would say between the countries. So it is the spot rates move due to the inflation, difference in inflation rates. So the formula is like this, that future spot rate is equal to spot rate now multiplied by 1 plus inflation rate in foreign currency divided by 1 plus inflation rate in local currency. So this is the formula. Now this question is asking you for the inflation rate. So you do have the future spot rate, which is 6.321. And this is equal to the spot rate now, which is 6.17. So this is to be multiplied by 1 plus inflation rate in the foreign currency. Which shall be divided by 4 and then divide by 1 plus 0.038 divide by 4. So we need to know the inflation rate in flyland, the foreign currency. So this is how we will know. So we need to know this, the inflation rate in the foreign currency. So now check it out, solve this one and get the rate. Inflation rate for central land is given. They are asking for the foreign currency inflation rate in the question. So the answer to this question is the foreign currency inflation rate. If you solve this mathematically, it is equal to 14%. It is approximately 13.68%. And they are asking into the nearest percentage, so you will take it as 14%. Nearest percent will be 14%. We'll round it off to 14. Yeah, it's 14. Okay, so now moving on to the next question, H company, question number 4. Students, you can please go through this uh, question number 4. I'll be back in around 5 minutes time. Uh, I'm muting this for 5 minutes. Please, you can read the question till I come back. I'll be joining in around 4 to 5 minutes, right? Divide by 5. This is an annual rate. They are asking about the annual inflation rate. So you have already taken 4 over there, na? So it is an annual rate. You don't need to divide. Divide by 4 will basically make it for a 3 months time. We don't need the inflation rate for 3 months time. We need the inflation rate for a full year. Back in 5 minutes time, students, if you allow me, right? Okay, students, I'm back. Thank you for allowing me to leave for a 4 to 5 minutes time. Great for allowing. Okay, now let's do this question. H company, which of the two following are possible reasons why the director decided that the bank loan was preferably uh, preferable to equity in this case. The factory will act as security on the loan. See, this cannot be correct because the factory is yet to be built. They don't have a factory right now present. How can they pledge it? How they can place it at security? So this is incorrect. Then they believe Modigliani and Miller's theory of gearing with taxation. That's correct. This one is correct because Modigliani and Miller says that if you borrow more, borrowing is cheaper due to the tax shield. As we use the tax shield in calculating the cost of debt. So due to calculating that using the tax shield, and as we save some tax due to the interest payments, and on dividends we do not save anything. So dividends are not to be deducted from taxable income, but interests are. So it saves our tax and it reduces our cost. So definitely by borrowing more and increasing the gearing, our cost can decrease. So this could be the reason. This is the right one. B. Then all equity sources have higher issue cost than the loan. So look, students, sometimes they make the question a tricky one. You have to read it very carefully. What word has been used over here? All means all equity sources. We have many equity sources. See, we can issue ordinary shares. It's an equity source. We can reduce our dividends and use our retained earnings. That's also an equity source. Do equity source have an issue cost? No. But issuing shares, yes, it has. So it's, if they say all, I do accept that some equity sources may have high issue cost, but not all. So that's not correct. This is not correct. This word all is making problem over here, right? So should be very careful in reading questions, right? So all equity sources do not have higher cost, some have, right? Then the services cost of the debt will be lower. So the servicing cost of the debt will be lower. That's correct. Debts usually have a lower servicing cost or interest rates because they have lower interest risk, therefore less interest rates. So that's correct. So the correct answer is B and D. So again and again, I give the same tip. Please read the question carefully. Sometimes the reason behind our wrong answers is not our knowledge. The wrong answers result due to not carefully reading the question. And one tip I want to give before our webinar ends today is that please students, don't study too much in the last moments. Study right now when you have time. If you study too much in the last moments, you do not sleep properly, right? And you do not eat properly sometimes, right? People eat incorrect food items at the last moments. Due to that, what happens that you are not able to concentrate in the exam, which is very important. You should take all steps that you can concentrate in the exam. Even if you lack some knowledge, doesn't matter. If you lack some knowledge, doesn't matter. But if you cannot concentrate in an exam and you have too much knowledge, you will be reading the questions incorrectly, and ultimately you will be marking incorrect answers. So what's the use of knowledge if you cannot properly concentrate and take proper care in the exam? Because it's really sometimes tricky to answer the true and false questions, like we had in the previous one. You have to take 4 of the true and false. Even if one of them gets wrong, you get no mark. So you lose completely, you missed it, right? So it's very important that those questions which have which asks you to select 2 or 3 items, and which asks you to uh, mark 2 or 3 items true or false, or 4 items, you have to be very uh, sharp at that time and careful at that time. And if you are not properly uh, finishing up with your sleep, and you're not properly eating and going into the center just hungrily, so what happens that you won't be able to perform over there, right? You can take some sweet items with yourself, some sweet biscuits or something, so that if you feel some glucose problem, if you feel sleepy over there, go please eat those items so that your glucose levels goes up and your brain works properly, it functions properly. So please do take proper rest before going into the exam. Plan your exam properly and don't hurry up. Never to hurry up, right? If you hurry, you may make mistakes, right? Be calm in the exam. Just try to concentrate on reading the exam and then doing it. It's you do have enough time. See, uh, you, the passing mark is 50, and if you select your questions properly, you will pass in 1.5 hours, isn't it? Shouldn't you pass in 1.5 year half mark, because 3 hours are given to obtain 100 marks. So even if you make a delay and you select the questions properly, you select the questions with good expertise and answer them first and leave the other ones which are doubtful to you or which you do not know, as I discussed earlier. And even if you get late in that case, you will be definitely passing in 2 hours if you pick the questions correctly. And even if you get late, you will pass in 2 hours, because you should get 50 marks in 2 hours. And afterwards, even you leave behind with questions which do not let you earn marks, no problem, you have passed. So it's better to pick good questions first, be careful, and do not hurry in the first 2 hours. Do it easily, comfortably, so that you can get marks comfortably. You do not hurry, and you are careful, and you get questions correctly done. And then in the end, you can hurry a bit, but in the end, obviously, uh, you will be left with those questions in which you expect that you will get less marks. Obviously, the high achievers, each and every minute is important, because they are going for 100 marks. So each and every minute of them will be important. Okay, so students, let's continue. Let's complete this question at least. Now the next question is, which of the following would not be a possible explanation for the normal yield curve observed? So which of them is not? Normal yield curve is not observed in market segmentation theory, because in the market segmentation theory there is a wiggle in between. So normal yield curve do not have a wiggle, right? Expectation theory is suggesting a normal yield curve. Yes. Okay, there's a question, which section should we start first? Okay, let me answer you. Yes, they do provide you with worksheets, but if you don't, please try to use the scratch card over there. Scratch card is available there. They give you a scratch pad on the screen. You can use that scratch pad. I believe that in the I don't know about it in Pakistan. I think they are not giving the sheets to write over, but sometimes the policies do change as well. Okay, so the correct answer to this is C. The market segmentation theory. So they gave. Okay, so they do give the sheets in Pakistan as well. So that will be comfortable for you people to use the sheets. Thank you, Aisha, for updating us. Okay, so next part is this one is an important one. C, select from the drop down list which represents the payment receipt payable on the FRA. FRA is a forward rate contract. In this question, look, in this question there is a terminology given over here. Let me tell you about this terminology. 3V9. What do we mean by 3V9? 3V9 means you can borrow or deposit money in 3 months for 6 months. So if you borrow or deposit in 6 months, the total months will become 9 months. And for this, you have been given these two rates. Now this rate, the lower one, is the rate at which you will invest funds. When you invest funds, this will be at lower rate, and 7.8 is the rate at which you are going to borrow. So borrowing rate will be higher, right? So remember this rule. The lower rate will be for the investment and the higher rate will be for the borrowing. Okay. Now let's move on to this question. Now they say that select from the drop down list which represents the payment receipt payable on the FRA if the reference interest rate moves to 7.6%. Now the reference rate moves to 7.6%. This means that the actual rate, when the 3 month elapses, the actual rate at which you borrow is 7.6%, right? But you have entered into a forward rate agreement. Your forward rate agreement is asking for 7.8%. So you can't pay less than 7.8. You have to pay 7.6% to the bank from which you have borrowed, and you have to pay the difference to the against the FRA to the bank with which you have entered into an FRA agreement. So you must pay 7.8%. So difference of 0.2% will have to be paid against the FRA to the bank with which you have entered into the FRA agreement. And if the rate is suppose 8.1% actual rate, then they will pay you 0.3%. If the rate goes above the 7.8% FRA rate, they will pay you 0.3%. And if the rate is below actual rate, then you have to make the payment. So in this case, the amount is 10 million. So on 10 million, you have to pay 0.2% for 6 months. So it's a 6-month loan. So 6 months, you'll have to pay how much? You'll have to pay 10,000. This is going to be a payment. The correct answer is a 10,000 payment, the first answer. Okay, students, 2 more parts left and then our webinar gets over. So which 3 of the following are reasons why futures are not always a perfect hedge? D is not the reason, because it is due to interest rates are hard to predict. We enter into future. They are not asking about why do you hedge, why don't you hedge for interest rate. They are asking why it is not a perfect hedge. Perfect hedge means that the future saves you amount which is equal to the actual loss being incurred. So you do not incur any loss due to having a future contract. So that's what known as a perfect hedge. So for perfect hedge means that suppose you incur a loss of $100, then the future helps you gain $100. So it gets perfectly offset. 100 is to 100. So you do not enter into any sort of loss. So perfect loss hedge do not occur due to what reasons? The A, B, and C. So the correct answer to this is D. D is the reason why A, B, and C is correct to this question, and D is the reason which is not the reason behind perfect hedging. It is basically the reason for why we hedge or why we use a future contract. It's not related to perfect hedge, it is related to the reason for the hedge. Okay, and then E, which of the following statements concerning FRAs and interest rate futures are true? So which ones are true? C is the correct answer. 1 and 3 is true. Forward rate agreements are never forward rate agreements are not standardized. You go to the bank and you can get negotiated the amount, whatever amount of forwarded agreement you want, you can take. Options may be of standardized contracts, and futures contracts can also be of standardized nature, size. So C is the correct answer for this, 1 and 3. So that's all, students, for the practice to pass sessions. Thank you very much to ACCA that it has given you such a good forum for you and me both to learn. Obviously, when I am teaching, I am also learning to teach you people. So ACCA has given me this platform to learn, and plus it has given me the platform to facilitate you people as well. That's also a compliment to me, an honor that I am helping you out. I am given a chance to help. So we all thank first of all to the ACCA, and thanks to you people for attending this webinar. And I hope you would have learned from this webinar, and I wish you all the best. And yeah, I'll be sharing the working paper, don't worry, on the group, and wish you all the best in your exams. I hope you pass in the very first attempt. Please do the exam carefully, and take care of the people around you, especially your parents. Welcome. My pleasure being here. Thank you, all of you. And at least I would say that please take care of people around you, your relatives, your parents, especially your brothers and sisters, and people elder around you, so that their prayers work out for you and help you out to learn faster and pass faster. Okay, thank you very much. Goodbye. My pleasure to all people who are giving me thanks. Please pray for me. Please pray for me as well, for my this life and life after death as well. See you. Khuda Hafiz. Allah Hafiz. The group as well, na, afterwards. So I'll be answering your questions. If it's better that you ask me on my personal WhatsApp, because if you ask question on groups, sometimes it gets confusing and doubtful for others as well, because they are not having those questions, so they get engrossed in unwanted problems sometimes. So it's better to ask on personal. So whenever I get time, I'll answer you. And it's better to ask in a voice note, so that I can understand properly. Sometimes the written questions are not that clear. See you. My pleasure.